The way I kind of look at it is I go to Star Trek, because Star Trek is actually a good indication of the different pieces of technology that have come into our world, right? You had Kirk with the flip phone.
Yeah.
If you go to Star Trek, The Next Generation, their consoles are iPads. Their communication officer always has an earpiece that they're talking into. So what's the currency on Star Trek? That's where everybody gets stumped. There's actually two currencies. There's Latinum, which is not a stable metal, so it goes into gold. So gold is still a form of payment. And there's Federation credits. Now, what's the blockchain? The blockchain is a ledger of debits and credits. And where does Bitcoin trade? On the blockchain, and can be used as a form of credits.
I love that whole explanation of Star Trek around Bitcoin. Fantastic. I'm actually waiting for the food replicator.
I'm not sure I want to eat replicated food. I'm not sure I want to go down that line.
Cool. Well, thank you for joining us on this beautiful afternoon. My guest today is Ann Bartels. She is Chief Investment Strategist at Sanctuary Wealth. And I have the great pleasure of getting her perspective on all matters of things, particularly with the investment markets and the things that she's tracking these days. We started out talking about the craziness in the market and tariffs, perhaps. But, this year, 2025, is really started out in, I guess, a volatile fashion. I don't know how you'd characterize it. It's been interesting, to put it in other words. What's your broad outlook for the rest of 2025, if you can even make that at this point, given the uncertainties about so much?
So we did come into this year very optimistic. The economy was doing good. We thought earnings would be great. We thought interest rates would trend down, and then there popped up Doge and tariffs. So, the markets have had a deep, fast correction, but we think we've reached the low at 48.35. It's a classic capitulation in terms of volume, the indicators like the VIX index spiking up, a lot of fear gauges going into the zone that we would say is buy signals. Normally, though, you kind of test these lows. So I think the market can stay choppy and volatile until we can resolve the tariffs. But what the market is telling me is that 48.35 is the low. And by next year, we're going to be at new highs. The market's also telling me that we shouldn't have a recession. When you go into a recession, markets go down about 30%. And we didn't go down 30%. And if we went down 30%, we'd be down around 4,400. And I don't see that happening. I do see a slower economy for sure, but I think we might be able to bypass a recession. Another indicator that's telling me that we can bypass a recession is when you look at cyclicals versus defensives. If you would expect us to really go into a recession and a deep recession, I would have major trend lines signaling that defenses are taking over leadership relative to cyclicals, and I don't. Everything is showing me that in a correction. It kind of reminds me of like 1998. We've been saying the market's very similar to 95 to the peak in 2000. And this kind of feels like that. It's very different. What happened in 98 was very different. That was a hedge fund that went under long-term capital and disrupted the financial system. But we recovered from it very quickly. And I think we'll be able to recover from this. I don't see any major damage being done. And tech still, believe it or not, looks to maintain its leadership.
Yeah. When you look at the market, I think you're looking at technicals, right? Or maybe you're looking at technicals and fundamentals.
Right now, what I'm referring to are the technicals within the market, correct?
How do you rationalize, I don't know, is the market fundamentally different than, say, it was in 98 or say it was just a year ago in terms of relationships to global partners and the administration's effect on the economy? I don't know. Is there a fundamental change where you go, okay, maybe the technicals, even though history says it did this, I've got to look at something else? Or
I can honestly tell you, I've been doing this for 40 years and it works. And every time it feels different. Every story is different all the time. But the market behavior doesn't change. It's really interesting. If you really know how to read the markets, it does not change. And despite every event being different. And do we have some black guys? I think we have some black guys on the US for sure. But if I'm correct about the leadership and AI coming back, blockchain is a major technology innovation, Meta with virtual reality. All of these, when I kind of bucket them and look at them collectively, it's bigger than the internet of the 1990s. So I think this is another major stepping stone in the evolution of technology. And what I do think is that having these tariffs, companies are going to adopt technology, I think, even faster to gain efficiencies.
Yeah, that continues to be an important topic. So that those changes, technology gives you an optimistic outlook longer term for the U.S. and the economy.
No, in fact, I haven't changed my long-term forecast for the S&P 500. I can still see the S&P getting to 10,000 to 13,000 before we have a major top within the markets.
Gotcha. What about global markets? Do you have a view globally? I've talked to some other parties and my guest just last week. We talked about the need to diversify globally, and now is a great time to do that. Do you think that there's an opportunity for U.S. investors that are perhaps overlooked?
I do. We've liked Japan for a while. We've liked India. But now with Germany committing to spend almost €1 trillion on infrastructure and defense, I think Europe is shifting in a much more positive tone. So between Europe and the two other countries, Japan and India, I do think you can diversify. And not that I'm telling people to invest in China, but even that market looks like it's bottomed, which I think is a really an important sign, just constructively looking at the emerging markets in general.
I'm curious because you mentioned India. It happens to be something that we are big proponents of at VanEck. Just fundamentally, if you will, do you have a sense from your technicals what you think of India in terms of richness or valuation?
I don't do the valuation in India, but from a technical perspective, it has a very bullish trend. So, and then of course the fundamental case, and you saw that with Apple announcing that it's going to move its US production of iPhones from China to India. So, India's, has educated talent and manufacturing capabilities. And so there's a strong underlying fundamental trend as well as a technical trend, I think, for India.
What about one of the other trends in the market are alternatives? Are you looking at alternatives for clients and your client advisors and helping them figure out how to use it in client portfolios?
Yeah, we have a very robust platform for alternatives, both on the credit side and the equity side. And many of we call them strategic partner firms, but the financial advisors that are working with their clients, many of them have adopted AI in their portfolios. But when you look at the industry as a whole and where advisors are in terms of adding alternatives into the portfolios, still very, very early stages. There's still very small percentages of alternative assets actually going into the portfolio. Some parts of the markets have done extremely well. So the valuations are not as great as they were a couple of years ago. So you do want to really do your homework when you're selecting what platform you want to participate in. But we do see a very long runway. And I might add that sports is probably the newest and most interesting part of the alternative space.
Interesting. Like from a private equity standpoint?
Yes.
Yeah. Yeah. Would that be one of the areas you were referring to in terms of valuation, private equity or private credit?
Yeah. Okay. You just have to be careful. Some valuations have gone up quite a bit, even on the credit side.
There really isn't a way to do technicals on that stuff, is there?
No. That's where you got to really do your fundamental work and understand where they're investing and what valuations you're going to get in at. Yeah.
What's your take in terms of the push for greater access to alternatives for more retail investors? Do you think more retail investors should have access to certain types of alternatives?
They should. And what I can tell you is the private market finally woke up and realized that there was a wealth management industry that had a lot of money, because the private market used to really only be for institutional investors, and it was very sticky. You would have to commit your funds, sometimes for 10 years. And an individual investor on average doesn't want to lock up their assets for that long. But the private markets realized that there was an individual investor that had an appetite to invest in the private markets, and they've created products that have more liquidity and have better access than they did a number of years ago. And I think you're going to continue to see that trend.
Yeah, it's been really interesting to see how that's been playing out, particularly since many private companies continue to stay private for so much longer now. You are almost forced to go into the private markets to source better returns.
Correct. When I came into the market, there were over 5,000 stocks listed on the New York Stock Exchange. Now it's just a little over 3,000. To give your viewers the concept that there's not as many public companies, and a lot of companies are private and choosing to stay private because they have the access to the capital.
What are you, outside of tariffs and some of the broad asset classes, just kind of curious, kind of top of mind with your partner firms, topics that you're talking about, things you're trying to solve for?
Well, see, in my role as the chief investment strategist is really trying to navigate the markets, the equity markets, the fixed income markets, the commodity markets. So that's what I spend most of my time doing. We also have an asset management arm, and I'm part of the council when we're trying to do the allocations in the portfolio. So we do have a council that votes what are the different allocations and where should we be allocated. In terms of alternatives, I have done some podcasts interviewing executives from the firms so they can explain their products, and they're available on all the platforms, Apple, Spotify, YouTube. I think it's part of an educational process, not just for financial advisors, but for individual clients that want to understand where they're investing their money. And my podcast is called Friends of Sanctuary.
Oh, cool. I'll take a look for that. And you mentioned commodities, kind of curious about commodities. That's always been a kind of a tough one for me to gauge. Outside of gold, and then gold has been running, what's the outlook for commodities?
So commodities, when you look at an index, like a CRB index or a Bloomberg index, they're very skewed towards energy. So you have to be aware that it's very energy heavy, even though you have like wheat and corn and soybeans and hogs and many other things in the index. I think we're in a holding pattern. We saw a major spike up in commodities because of COVID, right?
Mm-hmm.
And that supply shock and how prices went up. So did the commodity index. And now I would say we're in a holding pattern. But it's kind of interesting because when I look at the pattern, it looks very similar to the 1970s, where we had an oil embargo and we shot up. And that was like around 1972. And then from 72 to almost 80, we traded sideways and then had one more spike in the commodity index. And I'm of the belief that from moving away from globalization to being more isolationist in some ways, wanting to do manufacturing here it's also called onshoring or nearshoring. That's actually inflationary. When you're not going to the lowest cost producer, your cost structure goes up. So it is inflationary. I think we've shifted from a deflationary environment, which ended during COVID, to an inflationary environment. And we have to remember that inflation peaked in 1980. And we had a 40-year secular decline in inflation. And now I think we're in the early stages of inflation actually coming back into the economy. So I do think over time, inflation will go higher. That would mean commodity prices will go higher. It will also mean that interest rates go higher. But where we are in the cycle right now is we're in a cycle for inflation to come down off of those highs. We're also in a cycle for interest rates to come down. But then I think we'll bottom out and some of the rates might get very low. It's possible that we could get a 10-year treasury yield as low as 2.5%. We could get a 2-year treasury around 2%, even 1.8. And then I think that's it. Those lows are set. I don't believe we're ever in our lifetimes going to see a zero interest rate environment again.
Yeah.
And then I think you're going to see interest rates climb higher. The good news, that's good for baby boomers and for people that are in retirement because they're going to be able to get interest rates coupon.
Yeah. That was one of the features of last year was, I guess, or the last couple of years, is rates had gone up and the bonds were back again. And So there'll be some fluctuation, and we'll continue to perhaps see those rates continue to climb.
Right. And just because interest rates go up doesn't mean that you can't have fixed income in your portfolio. It's how you manage the fixed income in your portfolio. The fancy word we use is called laddering, where you buy different maturities. So you always have something maturing so you can go back into an investment, especially if it's at a higher interest rate. So just because interest rates are going up doesn't mean that there isn't a way to be able to invest in the fixed income market.
When you think about things like commodities and alternatives, and sometimes alternatives is a broad bucket in addition to privates, and sometimes commodities or other real estates in there. How do you start to think about putting that into a portfolio or helping advisors navigate how much to allocate to certain of those types of strategies?
That really depends on your client, their risk appetite, their liquidity needs, and how many assets they have, right? So it's really a portfolio construction.
But do you see them as a diversifier, kind of lower correlated, and so they can actually help lower portfolio volatility in the right?
So far, yes. So far, when you look at the private markets, they've substantially lowered the volatility within the portfolio. If you look at gold, which has been doing very well, it's been a nice diversifier within a portfolio. I don't like that we call the private markets alternative. I wish we could find another name, another category, because I don't think they're an alternative. I think they're part of the new asset allocation model. Gold has always been considered an alternative, and a newcomer, I would say, is Bitcoin. And I would say that there's a generational impact with Bitcoin. I would say baby boomers may not be really fans of Bitcoin, but as you go down in the generations, you will find the younger people already have Bitcoin in their portfolio.
Yeah.
Right. Outside of even having a financial advisor that they've, I've met individuals, in their 20s and, they've been in the crypto space for years.
Why do you think that is? Do you think it's because it was cool, or was it because they foresaw?
No, because it's digital.
Because it's digital. Right.
Yeah, I think it's because it's digital and they grew up digital. Because when I grew up, I didn't grow up with technology. I mean, my technology was a phone and a TV, and a longer cord on a phone. Black and white to color. I mean, I did not have my hands on a computer until 1987.
Yeah.
Right. Computers, PCs were just going into the workforce in the 1980s. Now, if you were a computer type of person, you could have gotten computers earlier, but you had to program them.
Yeah.
Right.
Yeah.
And not everybody was a programmer. They had to develop software and applications so people that didn't know how to program were able to use the computers. And when you look at the young people coming up today, they just grow up with technology. They're digital. It's part of their world. So for maybe you and I, having a $20 bill is kind of important to us. We still want to be able to touch paper, but younger kids don't need to touch that paper. And so I see us moving into a world that's fully digital. Someday I don't believe there will be any paper or any coins. It will all be digitally accessed. And I'll get pushback and say, well, Marianne, we're already digital with PayPal and Venmo and Zelle. And I'm like, but that's not money. That's a form of transferring payment. And I think Bitcoin is symbolic of the currency on the internet. We never had currency on the internet. And I think that's what Bitcoin is symbolic of. Now, whether or not it stays the currency of the internet, I still think is to be determined. But if you look at how Bitcoin has been trading relative to the other cryptocurrencies like Ethereum and Solana, it hasn't held up as well. And that's because they're pieces of technology. They're not a currency. Bitcoin is the only true currency.
Do you look at Bitcoin? Well, do you look at Bitcoin as akin to digital gold? That's perhaps one way we look at it. Or you've talked about it as a currency, so maybe that's a little bit different. But
it gets labeled as a form of gold, and then people will point out it didn't go up the way gold did. I think it's important that it's viewed as a medium of exchange. Mm-hmm. It's a digital payment, an actual exchange of monies. And I think that's the most important, whether we call it gold or not. Our Federal Reserve chair actually equated it to gold. So, if you had the Fed chair equated to gold, it's pretty interesting. The way I kind of look at it is I go to Star Trek, because Star Trek is actually a good indication of the different pieces of technology that have come into our world, right? You had Kirk with the flip phone.
Yeah.
If you go to Star Trek, The Next Generation, their consoles are iPads. Their communication officer always has an earpiece that they're talking into. So what's the currency on Star Trek? That's where everybody gets stumped. There's actually two
No idea.
currencies. There's Latinum, which is not a stable metal, so it goes into gold. So gold is still a form of payment. And there's Federation credits.
Huh.
Now, what's the blockchain? The blockchain is a ledger of debits and credits. And where does Bitcoin trade? On the blockchain, and can be used as a form of credits.
I love that. That whole explanation of Star Trek around Bitcoin. Fantastic. I'm actually waiting for the food replicator.
I'm not sure I want to eat replicated food. I'm not sure I want to go down that line, but they also had the hologram.
Yeah.
And I think part of virtual reality is the hologram. We're creating the new form of the hologram. So I think Star Trek is a good leading indicator of the pieces of technology that we are adapting.
It's going to take a long time to get there, right? In terms of where everybody's using.
I'm not sure we're going to get to beam me up Scotty in a while.
Yeah. On our way there, I mean, what do you foresee as kind of the next steps and the next evolution in, say, wealth management? Additional ways of adopting the blockchain, perhaps.
So the industry is already working on creating the blockchain for Wall Street. We will have a day where stocks trade on the blockchain. Buying and selling of real estate will be done on the blockchain. That's all being developed right now. So that's part of the next evolution. In terms of the next evolution of wealth management is the major wealth transfer that the industry is talking about, and how women will control the majority of the wealth in the next 5 years. And that will have probably major changes. I remember when I was an analyst at Merrill Lynch at the time, our economists wrote a report saying that women controlled the spending in the household. And I remember a lot of male clients with a little bit of pushback, but the data supported that women really are the major household determiner of where money gets spent. And so as the wealth transfer happens and the wealth gets transferred to women, I think how we invest has started to change and will continue to change. Women tend to be a little bit more conservative. We live longer. They don't like taking as much risk. So that'll be some of the changes. Another change is the younger generation and women. So it's not just women, but it's also the younger generation want to invest based on their values, what's important to them. And they're willing to give up a return to invest in what they believe in. So I think those are some of the changes that you'll see in wealth management and how money gets invested.
On that last point, do you see ESG or whatever it is, the next iteration of it continuing to some extent then because of that, if they invest based on their values?
So this is kind of interesting. When I was in the industry in the 1980s, we called it social responsible investing. Then we came up with ESG. It's also known as value-based. It's always going to have a name in the sense that people are paying attention to where their money is being put. I think that's the change. I think many investors just trusted their financial advisors to make the investments for them and maybe didn't really pay attention or go through with a fine-tooth comb where they were putting the money, as long as their portfolio is performing well. I think investors today are taking a more proactive stance in working with the financial advisor to build a portfolio that represents who they are.
Do you think product sponsors like myself and other shops should do more of that, offer more products that offer some kind of values-based overlay, whether or not we call it ESG or what have you?
As long as there's a market for it, right? If you can identify a market where investors want to put their money and you don't have a product there, then yeah, absolutely. Put the product there, but it's about finding what that product is. And what's really interesting is when I came into this industry, it was really equities and mutual funds. And now we're seeing a major shift away from mutual funds to ETFs because they're more efficient. It's a lower cost base. They're more tax efficient. And I think that you're going to see that trend continue. And once they change the regulation where you could have more active management within an ETF, that's the other major change that's occurring, that you can create a portfolio wrapped around an ETF. And those are, if you have the right product, they gain great traction. And that's a trend that I think you'll continue to see.
Yeah, we've been seeing a lot of new active ETF launches and active ETFs getting pretty good flow. I think something like 25, almost 30% of the ETF flow in the industry over the last year or two. It's been a big space. A lot of that's coming from these option type strategies or defined outcome strategies in terms of numbers and even some flow. I don't know if you've looked at any of those or even consider some of those.
Well, I mean, some of the option ones is where they can take in premium without getting into the minutia of it, because I don't know who your viewers are. But the concept is that you can take in income, and that helps to support the return and cushion during the downside. And those tend to be very popular. The other new ones that have come out are called buffered ETFs, where they have downside protection. And when you have market volatility like this and clients that are very nervous, if you can offer a product where you can participate on the upside, but have some cushion on the downside, they tend to be very, very popular. And before we had ETF wrappers like that, when we were able to do what's called structured notes, when I was at Merrill Lynch, they were very popular. But now they've been able to take these structured products and put them in ETFs. And I think that's going to remain very popular.
All right. I'm going to ask you a question about education and the need for education, kind of with the context of women controlling more of the finances, whether they are widows or just being more in control. Definitely going to be living longer than men generally. But are you guys doing anything? Are you personally involved with helping to educate women? What more, or perhaps what more can the industry do to help raise the education level on investment topics?
Well, what I will tell you, what the industry, I believe, is trying to do is when the husband dies and the wife gets the transfer of the assets, 70% of them leave the financial advisor the husband is with. And that's because the advisor did not create a relationship with the wife. And so I think advisors are being educated, and we do this certainly at our firm, the need to have multi-generational relationships. It's really about multi-generational relationships. In fact, one of our partner firms was proud to say at one of his conferences that he has representation in every decade from the 20s, 30s, 40s, 50s, and 60s. Where you want to touch base. It's not a one person, it's a family. You want to create a family relationship and then create education. It's not so much education. I think what's most important is that an advisor sit down and actually listen to what the person wants or what the family wants. And then structuring a portfolio that represents what the family wants to achieve. And that's called goals-based investing. Today, financial advisors are not just investing in a portfolio, they're helping with tax planning. They're helping build out your whole life, right? It's not just about a portfolio. So it's about education around the whole structure. Do you have enough insurance? How are you doing your tax planning, as you move out throughout the years? How do you want your transfer of wealth? What's your philanthropic goals? There's so many, what's your health needs? If it's a younger couple, what's the educational component if they have children? So it's really building out a very multi-dimensional portfolio for a client. So it's education that an advisor needs to be able to do that, to be able to have the resources for the firm to have a platform so the advisor can do that for the client, as well as then the advisor having the team to be able to meet with the family and be able to structure this so they can keep the assets. Otherwise, assets move.
And the idea of educating advisors, kind of going back to our discussion on cryptocurrencies, how important is it for advisors to understand blockchain and cryptocurrencies and the
It's
various
really
forms?
important because of the multidimensional aspect of it. And, if you have an older client and they have children, are they interested in crypto? Are they already invested in crypto? These are things that an advisor really needs to know. And at Sanctuary, we're very proud that we launched a crypto platform for our advisors and education around this, because we see that this is where the industry is moving, right? You can stay stagnant or you can grow. And this is a digital world. And we need to be able to understand and offer the products that are out there, not hide and be afraid of them. There has been some concern about the regulation around crypto, but some of that regulation or the attitude of the government towards crypto, I think, has a little bit more clarity around it. But what we also point out is crypto is still here, hasn't been broken. It's been through a lot. Many governments have tried to shut down Bitcoin and Ethereum, and it's still here.
Yeah, it's true. It's had its ups and downs and its cycles, and it continues to grow. And I think maybe more than anything right now is I just think about it from an advisor standpoint, just getting up to speed. You have to know about it. I mean, that's, I think, the way that we approached it at Van Eck, which was, we're not exactly sure where this thing is going to go yet, but we feel like we really need to be up to speed on this because it could be transformational for investing and for the industry and business as a whole.
I absolutely agree.
And for an advisor's relationship with those other generations, yeah, if the younger generations preferred a digital world, then yeah, you should reach out to them in that way. In our earlier conversations, during one of our prep calls, we talked about the volatility in the market, and we talked a little bit about how to coach advisors or coach advisors help coach their clients even in terms of managing through this volatility. There's headline news every day. Seems like some pretty big news every day that's just creating a lot of volatility. I don't know, what's something kind of just top of mind you might suggest that would help an investor feel a little bit more comfortable about their portfolio?
Yeah. In talking to advisors, there are many clients that are very nervous and want to sell, but it's about educating your clients about markets. And I've been doing this for 40 years. And for 40 years, there's always been a reason not to invest in markets. Yet in January of this year, we were reaching record highs in the markets. Let's not forget that we did reach record highs in January of this year. It's about structuring a portfolio that can weather the volatility within the markets. And depending on your client needs, depends on how you do that, whether you do that through alternatives. Does your client need income? So you've created a portfolio that's generating income and actually rising income. So as the portfolio may be losing value, the income can actually be rising. I've seen portfolios structured like that. So it's about knowing your client, knowing their objectives, and then building that asset allocation around what they need. So when we have periods of volatility like this, they can get through it. And it's also about reminding clients that we've been through rough times before. I would have to say, and my first bear market was the 87 crash, but I would have to say out of all the bad bear markets, and that includes the tech bubble of 2000, I think 2008 and 2009 was probably the worst for me because it involved our financial system and it involved my company. So it really did feel pretty bad. But let's go back and look at 2008 and 2009 and where we are today. And that's, I think, the biggest piece of education is I have a chart of the Dow Jones Industrial Average going back to the 1920s. And it moves from the lower left to the upper right. Even when we mess things up, we find a way to fix them and things move on. Companies here in the United States know how to grow earnings. At the end of the day, markets go up based on earnings. I mean, you can use technicals And we have all different kinds of, cash flow, PE types of measures. But the truth, when you really look at what is the single factor that drives a stock or a company and the market higher, it's earnings. And if you don't produce those earnings, the stock price eventually goes down if it's been up. So earnings are the key. And companies here in the United States have learned how to manage earnings very robustly. And I think artificial intelligence, AI, is going to add another level that will allow companies to be more efficient, improve their margins, and have their earnings grow.
I agree. The U.S. market in particular has been particularly resilient over the long term. I don't know. Do you know that I used to create those long-term charts for a company called Ibbotson Associates? I used to be the
I
product
did not
manager.
know that, but those are great charts. I used to use those all the time.
Cool. That was kind of one of my first, forays into the capital markets and investment markets. That was fun. Moving on to closing up our discussion here, I'd love to get your take on something that's top of mind for you. What's one long-term trend you see playing out over the next year or several years? It could be anything, something you've mentioned already, or something totally different.
So there's all different kinds of cycles. There's long cycles, there's medium cycles, and short cycles. I feel the market today looks too narrow. We become too trading oriented. And, whether it's hedge funds, I don't want to pick on the TV media because I like them very much, but they tend to be very more short-term oriented. And the long-term trend is the most important in terms of the cycle. And I still believe we're in what's called a secular bull market, meaning that even when you have bear market corrections, like the correction that we're in now, you will recover and you'll go on to all-time new highs. When you enter a secular bear market, the decline is very deep. It's normally about 50%. You go nowhere for at least 10 years or 15 years. And in many cases, you have two major declines of 50%. Now, you can make money in those markets if you know where to be, but they're more challenging markets. So when all of the tariff events happened, the first question that was most important to me is this the end of the secular bull market? And my answer is no. We're still in a secular bull market. And that's where I can get the S&P up to 10,000 to 13,000. And the leadership here is tech, and I'll call it tech related, right? Because companies like Alphabet or Google, Meta, Amazon are not in the tech index anymore. They're located in different sectors. So I like to call it tech related, are still the leadership. But the single leader has been semiconductors. And even though we're in a deep correction for semiconductors, their long-term trends are still intact. So I still believe that semis will come back. They may not have finished their correction yet, but they're the true leadership within the marketplace. And then when I look at tech and different components like software, they held in this correction, we're still holding long-term uptrends. And to me, that's the most important. And so I believe between now and the end of the decade, the markets are going to do astonishingly well because we are still the leaders in artificial intelligence. Alphabet and Amazon CEOs just told you they're not stopping investing in this space. So it's about knowing where to be. So one of the things that the market looks at is growth versus value. And tech is growth. And I think at the end of the decade, we'll lose growth, right? It'll peak out. And that's when we're going to get big value. Value will come back. I think that's when small caps could come back. So, even though I say a secular bear market, there are many opportunities, but you won't want to be in the leadership of the market because they generally go down quite sharply. As I said, on average, markets will go down 50%. So again, probably the most important thing is to always have a diversified portfolio to weather all markets.
Always a good rule of thumb. Thank you for that. That was great. How about a quick round of trend or fad?
Trend or fad? Okay.
Yeah, let's see. AI-driven portfolio construction. Trend or fad?
I'm going to lean towards fad.
Gold bars from Costco. Trend or fad?
That's going to stay a trend. I even have mine on. It's not from Costco, but I have my little gold thing. Yeah, I think gold stays very bullish. Can I say one thing, which is really important? Gold right here, I wouldn't chase it. It's gone parabolic. I would buy it if it has a good pullback. But gold stocks have not participated on the move, and they just broke out. I think gold stocks right now look very interesting. So gold in general, I think, is a trend.
Why do you think that is? What do you think the miners hadn't gotten the love until more recently?
I think part of it is because most companies hedge their gold exposure. But now with gold up so substantially and the valuations attractive, I think the market finally looked at the trade-off between, do I buy gold here or am I getting better value in terms of gold in the stocks? And by the way, that's very normal. We've seen that through history, where gold will make the move first, and it takes a while for the gold miners to actually respond. And again, part of that is due to the hedging.
And then the last one, self-driving cars, trend or fad?
Oh, that's a trend. I was out in San Francisco not that long ago, and Waymo is out there, driverless cars, and people are using them. What shocked me the most, it's not cheaper to use them. It's the same as Uber, but people are comfortable. I mean, San Francisco is the birth of even Uber. So no, driverless cars, that they're here, and that's Waymo, and they're moving. They're also going to have Waymo in Austin, Texas.
They do. I was just in one.
Yes. So this is a trend.
Did you ride in one yourself?
No.
Would you?
No.
Not yet.
Not yet. And I'll tell you one of the reasons why I didn't do it. They can't always drop you off in front of your location. Right? For safety reasons, they have certain spots where they can drop people off.
Yeah. Yeah. I did ride in one in Austin. It was pretty cool. I mean, fortunately, it was just around downtown, wasn't on the highways or anything like that. But I gotta say, it was a pretty cool experience. Although I did see a headline of some article recently, I don't know how true it was, where some people in Austin got stuck in the Waymo car because it stopped on the way onto the highway and they couldn't get out.
Yeah, there's been stories like that. We're not 100% there, but it's a trend. We're moving driverless.
I'm looking forward to that too. Well, this was awesome. What's the best way for people to learn more about Sanctuary, the research that you do, or follow you as well?
LinkedIn. So Sanctuary page, Sanctuary Wealth, and my page is probably the best way to follow what I'm doing and what Sanctuary is doing.
Fantastic. Well, Marianne, thank you so much for your time and your insight.
Well, thank you for having me. I really appreciate it.
And thank you for tuning in to another episode of Trends with Benefits.